Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to purchases and sales involving foreign currency. So we're going to have purchases of items, sales of items, foreign currency being involved within the transaction. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter that into the blue area on the right-hand side and into our worksheet where we have year 1 and we have year 2. We're going to take our information on the left-hand side step by step, item by item. We're basically having sales and purchases, but with a foreign currency component to them. I'm going to highlight, I'm going to select these items, and I'm going to make them green, working on the ones that are in green. So we're going to be working on the ones that are in green. So we're starting off on 3-1, a U.S. company sells to Canadian company. So we're always going to be the U.S. company. We're making a sale of some kind to a Canadian company, right? So this happened on 3-1, I'm going to say X1. And then it's going to be receivable on 5/30. So, and then the spot rates are going to be down below. Those are going to be our rates we'll use in order to calculate the difference in currencies. So we're first going to say that we have a receivable. Same kind of, we have a sale taking place. We're going to get paid later. It's going to be in Canadian currency. So I'm going to put receivable and I'm going to mark it that we're going to get paid in basically the Canadian currency. And then we're going to multiply this out to record our books basically on the US dollar. So we're going to be getting 42,000 Canadian dollars, and we'll multiply that times the spot rate at that point in time, because that's all we can do at this point. We're going to say times 0.65, 27,300. So if we were to get the money today, then we would think it would be worth 27,300 because that's the exchange rate today. But of course, we're not getting the money today. We're going to get it in the future, and that rate could change. So we'll have to deal with that. So it's a receivable. The receivables on the books. I'm going to do the calculation here once again. The 42,000 times the 0.65. Then the other side is going to be sales. So we'll pick up these sales down below. And there we have that. And that's going to be the credit. So let's go ahead and record this out just like we normally would. And I'm just going to have a really basic worksheet here just so we can concentrate in on our transactions and actually see them posted to something at least, right? So we're going to say 27,300 goes up. And then we have these sales go up. And that, of course, increases the revenue by what we believe the best thing we can do, which is the exchange rate right now, even though that even though that receivable will change, over time, because we don't have the money yet, and we're going to get the money in Canadian dollars. Okay, and then what happens on 5/30, X1, we're going to get money. So, but the exchange rate is different now. So the spot rate is different. We're going to call it the spot rate, rather than we'll see forward rates later. So spot rate has now changed. The difference is the 68 minus the 65, right? So in other words, we originally thought, of course, we were going to get that 27,300. Now we're going to get 42,000. We're going to get the 42,000 Canadian dollars, but now those are worth, in terms of the exchange, times 0.68, 28,560, right? Because the exchange went down. We have one Canadian dollar was worth 0.65 US dollars. So the exchange from Canadian to US dollars. And then we have one Canadian dollar now being worth $0.68 here. So that's going to actually result in a gain to us here. So we got a gain that happened. And if you think about this in terms of strength of the Canadian dollar, notice we're going to get Canadian dollars. The Canadian dollars got stronger, which means their purchasing power went up with relation to the US dollars since we originally made this. So that's why, since we're getting paid in the Canadian dollars, we actually made out on that, right? So that's why we're going to have a gain. So let's first record the gain. We got to record the gain to match, so that it will help us to match the fact that we're going to be getting that 28,560. So we're going to say, all right, well, the accounts receivable is going to go up now. It's going to go up, and we can calculate that here, and we can calculate that by the difference between that 28,560 that we calculated minus this amount. Or we can take the easier calculation if you just have these changes is the difference, right? We could say, all right, this is going to be 0.68 minus 0.65 times the 42,000. So we're going to have to adjust it by the 1,260, which of course is the same as us saying 42,000 times the 0.68, which is the exchange rate now, minus the 27,300. That would give us our 1,260. So we'll do that with a formula here. Let's do that with a formula. The formula is going to be equals brackets. I'm going to take that 68 minus 0.68 minus the 0.65, closing up the brackets, multiplying it times the 42,000 Canadian dollars. So now we've got a difference of that 1,260 debit and the credit. That's going to be a foreign currency gain. We're going to have a foreign currency gain on that transaction. Strengthening of the Canadian dollar compared to the US. All right, so then we got the accounts receivable. I'm going to F2 plus F2. We're going to bring that up by the 1,260. And then we've got this gain down below because because that happened. So that's good. All right, and then next thing that's going to happen is we're going to get paid, of course. So now we can record the receipt, now that it's on the books at the proper amount, to 28,560. So we're going to say, all right, now we're going to get currency, but we're going to get currencies in the Canadian units now. So we're going to get Canadian units of currency that we're going to put on our books valued at the US, amount, the exchange amount. So, and then the other side is going to be the receivable is going to be going down. It's going to be for that 28,560, which we can calculate once again as the 42,000 up here times the 68, the amount at the spot rate. There's the 28,560. There's the debit. There's the credit. Let's go ahead and post this out. We got the foreign currency. So we got the foreign currency with the CAD, Canadian dollars. And then we're going to be decreasing this amount for the accounts receivable. I'm going to say F2 plus F2 and bring that on back down to 0. Let's go on down to the next problem set here. So the next problem set is going to be this information. I think all of that is going to be included. This is going to be in the Japanese yen, I believe. It's yen. And so we're going to close this or ungreen this. We're going to ungreen that and green this one. So then we got on 7-1, U.S. company enters into a contract to purchase machinery from a Japanese company. So again, we're the U.S. company. We're purchasing machinery from a Japanese company. And the cost of it is going to be 400,000 yen, right? Japanese currency. And so we're going to say, all right, and then the delivery date is on 8/30. That's when the actual delivery date happens. And then on 10/29, the payment due 60 days later. So that's going to be 60 days later will be October 29th. So here's the spot rates for 7/1, 8/30, 10/29, and we're talking the exchange from or the change from the Japanese currency, the yen, to U.S. currency. So one foreign currency, Japanese currency, yen, compared to 0.102 dollars. And then we've got on 8/30 X1, 60-day forward exchange rate is going to be down below. And this is really just added data. I don't think we're going to be dealing with the forward exchange rate in this transaction, but we will be seeing it later. So oftentimes just note when you're doing, obviously, multiple choice questions, you got to know the difference between a spot rate and when you use the spot rate and when you use the forward exchange rate. And so here we're going to be typically using the spot rate. So we're going to say, all right, 8/30. Let's do that again. We're going to be over here. We're going to say this happens on 8/30 and X1. Now notice on 7/1, that's when the company enters in the contract to purchase from the Japanese company. That's great. There's a commitment that happens there, but we don't own anything yet, and there's been no consideration that took place. So even if we said, hey, this is gonna happen in the future from a financial standpoint, we haven't paid for the property, and we haven't, or the machinery, whatever we're buying, if it's a forklift, we haven't paid for it, and we haven't received it, right? So there's nothing that we're going to record at that point. But then on 8/30, there was a delivery that happened. So now we've got the machinery. So now we're going to say, all right, now we got the machinery. We're going to put that on the books, and we're going to put it on the books at the 400,000, and we're going to be taking that times the current, the exchange rate at that date, at that point in time, which is going to be at 8/30. So we're going to say, all right, this is going to be the 400,000 times the 0.104, because that's, one Japanese currency is going to be 0.104. On the U.S. currency, that's going to be the exchange. So the 400,000 then yen is going to be equivalent on that point in time with that current exchange rate of the 41,006 on the US dollar side. So that's going to be the machinery, and then the payable is going to go on the books. So now we purchase something. I'm going to put the payable for, we're going to have payable that's going to be payable in yen, right? And so we're going to put that on the books. And of course, on our books, we're putting it on the books basically in terms of the US dollars noting the yen. And also note, of course, that the accounts payable here, we had to put it on the books for the current time period, even though it could change, right? Because obviously we're going to pay it in the future, and the exchange rate will be different, in the future when we pay it. So all we can do is with what we have right now. So I'm going to say the machinery is going to be going on the books for the 41.6, and then we've got the accounts payable in yen is going to be the 41,006. So there we have that. And then on 10/29, the payment is due, and that's going to be 60 days later on 10/29. So I'm going to say we're going to have then 10/29. I'm going to say X1 is now due. So we're going to say that there's going to be a change now in the payable. So similar to the receivable we had up top. So because now we're going to be paying the 400,000 yen, but the exchange rate is different now. It's now at 0.106. So now when we pay it, it's really 400,000 times 0.106 at that point in time that we pay it, which is 42,400 minus the original amount, which was the 41,600, is going to be an $800 difference. And that $800 difference is now going to result in actually a loss that happens. So now if you think about that, you're going to say, well, why would that happen? And remember, what happened here is for 1 yen, it was 0.104. And now for 1 yen to dollars, it's worth $0.106. So the yen increased. The yen got stronger versus the dollar, right? 1 yen accounts for a higher fraction of a dollar. So the yen got stronger, and we're going to be paying the yen in the future. So that means that when we originally contracted, it was worth only 0.104 times the 400,000 of dollars. Now the yen got stronger compared to the dollar. So that results in basically a loss to us. So you want to kind of consider that, because when you think of the multiple choice questions, it can get really confusing when you're talking about purchases versus payables. When the currency, what's it mean for the currency to get stronger or weaker? And then what's that going to correlate to over time? So you kind of want to think in terms of strengthening and weakening, and then what's going to happen. And obviously, when you do the best way to really do that is to do these journal entries, because then you'll be able to calculate it, and you'll see these things, and you'll see clearly what's going to be happening. So we're going to say, all right, then we have a loss here. So now I'm going to put the loss on top, because that's going to be a debit. And that's going to mean the accounts payable is going to be increasing. So we're going to increase the accounts payable for the yen. And let's do the calculation this way. I'm going to say brackets. And I'm just going to take the bigger, I'm always just going to take the bigger number minus the smaller number, because I want this to come out positive. So I'm going to say the bigger number down here minus the smaller number. We're comparing what happened on 10/29 to 8/30. And then I'm going to multiply that times the 42,000. Or I'm sorry, not the 40, the 400,000. So there we go. There's the 800. So the 800 and the 800. Let's go ahead and post that out. So we've got the foreign currency loss down below. Foreign currency loss on the 800. And then we're going to be putting that into the accounts payable related to the yen. So accounts payable, something's in it. So I'm going to say F2 plus F2. Pick up that $800 there. Now we're going to be needing to pay this thing off. But let's say we don't have the currency yet, because obviously we're going to have to be paying it off in yen. And so now we're going to get the currency and then pay it off. So, right, so we're going to say cash is going to be going down, and we'll get ourselves some yen that we'll record on the books here. So we're going to say, all right, foreign currency is going to go up. We're going to record that foreign currency in terms of the cash equivalent on our books, but we're going to say we're holding on then to yen here, right? So we're going to say, all right, and then what's going to go down is going to be the cash, and then that's going to be equal to the same exchange component. So we're going to say that's going to be the 400,000 times the spot rate on 10/29, or that's that 42,400, which of course is the amount, the 42,400 that we need to pay off in US dollar equivalents. But now we have that 400,000 in yen that we can use to be paying it off. So let's go ahead and record that. We're going to say, all right, now we're holding on to yen, which is going to be equivalent to 42,400 of dollars at that current time. And then the cash, the actual US dollars, are going down. Now we can actually pay this thing off finally. So we can say, all right, let's pay this thing off now on 10/29, and we're going to be saying that we're going to be paying off the accounts payable. It's going to go down, and we're going to be paying it off now, not with the cash. It's recorded basically in US dollars here, but it's representing the fact that we own an equivalent component or portion using the spot rate of the yen. And so there we have that. And that's going to be going off at that 42,000, which you can calculate the same way, which is the 400,000 times the 0.106. So there we have that. Let's go ahead and record it. Accounts payable first. So here's the AP accounts payable. We're going to say plus. There's that 42,400 and enter. Here's the yen up top. So here's that. Double clicking on that, going to the end of it to plus, and we'll pick up that 42,400 there, bringing it back down. So now we've got our cash over here. We're holding on to some Canadian currency that we're representing on US dollars from the first transaction. We got our machinery on the books, and notice it's on the books when the transaction basically, as of the time period that it basically originally took place, right, which was the 41.6. And then when we had those differences in the currency, we recorded them as a loss. We didn't change the value, in other words, of the equipment due to the difference in the pay period timing. So we put it on the books at the time period that we purchased the equipment. Okay, so now let's go to the next one, which is going to be the inventory. So let's go ahead and highlight this one. Let's make it green. That's the one we're working on, the green one. And then let's ungreen this one because we're not working on that one. That one has now been completed, so we'll ungreen that one. So we have on 11/16, the U.S. company is going to be us, purchases inventory from a London company at the price of 20,000. I believe that's Great British pounds, which is going to be the pound. We'll call it the pound here. And so we've got 115x2 is when the payable is. The spot rates for November, December, and January 15th. So November 16th, December 31st, and January, the relevant dates. £1 compared to the relevant number of dollars at those points. We also have the forward rate here, which we won't be using in this problem, but we will be using forward rates later. Okay, so first we're going to say, all right, so the company, us, U.S. company, we purchased inventory for 20,000, and we're going to pay it at a later point in time. So that's going to happen on 11/16. We're going to say X1, 11/16 X1, and we will then say that we have typical kind of transaction inventory going up, and then the accounts payable, but we're going to note that we're going to pay the accounts payable in the pounds. So then we'll calculate this out. We're going to say that, let's pull out the trusty calculator here. Trusty calculator went to the wrong screen. So I'm going to pull it on down. And we're going to say that we have the 20,000 times the rate that we have right now. Now, we're not paying it right now, but we're going to use the exchange right now so we can record it, basically representing it in US dollars. So we're going to say 1.65, and that's going to be the 33,000. So let's do that calculation here. I'm just going to say it's going to equal the 20,000 times the 1.65. So 1 pound converts to 1.65. Therefore, 20,000 pounds will be the 33,000 in US dollars. So here's the debit and the credit. Let's go ahead and record that. So we'll put the inventory then up top. So here is the inventory. We're going to say that that's going to be equaling to the 33,000. Then we have the accounts payable. The accounts payable in the pounds is going to be equaling to the 33,000. Now, obviously, the inventory is on the books for that point in time. The payable is going to be owed, but we're going to pay it in pounds later. So we'll have to deal with that difference in rates. And first, we're going to have to deal with that at the balance sheet date. If we make the financial statements, let's say at 12/31, X1, balance sheet date happens. So now we're going to say, well, we got to revalue that payable to what it should be like now. So we're going to pay pounds later, and we have to say, well, 20,000 pounds is now worth in December 1.63 US dollars for 32,600. The difference between the 32,000 and the 33,000 is going to be a $400, and that's going to be a gain. Now, why is it a gain? You want to get used to just going, what's going to happen with these items. We owe money in the future. We owe it in pounds. And it was that 1 pound equals $1.65. Now we're going to pay those pounds later, but when we pay it, 1 pound is worth only, it went down to $1.63. So the pound got weaker compared to the dollar. The dollar got stronger in relation to the pound. So therefore, we're going to be paying off with weaker currency. We're going to be paying off with a pound that we've already committed to because we already got the inventory. So that means that we actually have a gain from this transaction, that difference that's taking place. So we're going to say, all right, that's good. But we have to adjust then the payable to what it would be, which was at 32. So we're going to say, all right, this is going to be the payable. We only owe the US equivalent of 32 now. So that's going to be going down. And the other side is going to be a gain because we're still going to basically be representing the inventory on the books at the original kind of cost when we originally, did the deal. So we're going to say, all right, then this is going to be the 20,000. Let's do it this way. Hold on a second. This is going to be equal to brackets. I'm going to take the bigger of the two numbers, this number minus this number to make it a positive on the debit side. Close up the brackets times the 20,000. So the difference between those two rates times the 20,000 is another way to calculate that $400 change. So there's the debit and the credit. Let's go ahead and post that out. So we're going to say, all right, here's the accounts payable up here. That's the wrong, we want this one. F2 plus F2. And that's going to be $400 difference. So now we only owe in equivalent US dollars the 32,600. And then we have this foreign currency gain down here. Double clicking on that, going to the end of it, and plus that 400 here. Okay, so now it's going to be due in the next year. So what I'm going to do is take these ending balances. Here's our ending balances. We're going to start that as our beginning balances in year 2. And of course, the equity section here has now rolled into the equity section here, and we'll just keep pushing forward with this. Okay, so the next thing that happens is that we're going to make the payment on January. So January is when the payment happens. So it happens on 1/15, let's say X2. And so we have to revalue this thing again for the spot rate change in January. So let's pull out the trusty calculator. We're going to say currently it's on the books at 32,600, but now the exchange rate is this 1.64. So if we take that 20,000 times the 1.64, we get the 32,800, which is $200 higher. So we're actually going to pay any current equivalent dollars, $200 more dollars now. And that's going to be a loss. So now we had a loss. Why? Because we're going to be paying in pounds. And it was, last time we checked, at 1.63 for 1 pound. But now for 1 pound, it costs 1.64, which means the pound has gotten stronger relative to the dollar. The dollar has gotten weaker relative to the pound. And since we're paying in pounds, then that's going to be, worse for us. It's going to be a loss. So we're going to say, all right, let's put the loss on top. Now we have a loss. Now we should have just paid it off in December. It's what we should have done. But in any case, we're going to say loss is here. And then we've got the payable. And then same calculation kind of thing. I'm going to say this equals brackets. I'm going to take the larger of the two spot rates minus the other one, to put it on the debit side, because I want the debit to be positive, times the 20,000, and there's that $200 difference. There's the debit, there's the credit. Let's go ahead and post this out down below. We're going to say that this is going to be equal to that debit of $200, and then we have the accounts payable down here, the accounts payable being equal to the $200 there. Okay, so now let's say we're going to pay this thing off, but we need some pounds to do so, because we're going to pay it off in pounds. That's what we said we were going to do. So we're going to say, all right, now we got to get some pounds. So we're going to pay some cash. Cash is going to go down, and we're going to pick us up some pounds. Let's pick us up some pounds. And so that's going to go up. We're going to record those pounds on our books in US dollar equivalents, just basically representing now that we've got that currency in pounds. So we're going to be picking up the 20,000 pounds at the current spot rate. So the 20,000 pounds times the current spot rate, which is the 1.64. And there's the 32.8, which is of course what we owe. And this is in, dollar equivalent terms, but we now have pounds that are equivalent to that amount. And there's that. So now we're going to record this out. So we'll say, all right, now we've got the pounds. Pounds are now being increased by the 32,800. And then we've got the cash. The cash is then going to be decreased up above. This is going to be equal to the 32,800. Okay, so now that we have our pounds, we can use those pounds to pay off the debt. Now, of course, again, these debt and pounds are being represented on our books in cash equivalents, but they're representing the fact that we have pounds equivalent to that, 20,000 pounds at this point in time. And then we owe those pounds, which represents, 32.8 in US dollars. Okay, so then we're going to say that we then have the payables going to go down. We're going to be paying off the payable. Pay off the payable. That's what you do with payables at some point, hopefully. And then the pounds are going to go down by the same amount, which you can calculate one more time just for the fun of it. So 20,000 times the spot rate at this point, at this date, 32.8. All right, there it is. Let's go ahead and post this out. So we've got then the pounds, and I picked up the wrong payable in the Great Britain. Okay, and then we're going to say, all right, there's the 32.8, bringing it back down to 0. That makes sense. And then we've got the foreign currency up top, double clicking on that, plus the currency in units, taking it down. Okay, so now we've got our cash on the books. We're still holding on to some Canadian dollars, which we're representing in the US equivalent at this point. And we've got our inventory on the books, and we've got the machinery on the books. Notice the inventory is on the books for the original exchange rate, and then we've recorded the change in the exchange rates with the gains and losses over the time. And then we have the machinery, and we've paid off our payables.